When you analyze why New York Life has consistently been able to provide superior financial protection for policyholders, it's clear that one very important factor is our mutuality. New York Life has always been a mutual company. We have no shareholders and we issue no stock. For more than 160 years, New York Life has served just one constituency, our policyholders. Publicly owned companies are under constant pressure to reward investors with immediate returns, and that can sometimes mean taking greater risks with assets. New York Life, on the other hand, is concerned solely with protecting the long-term financial security of those who insure with us. For example, you might not be aware that as a mutual life insurance company, New York Life uses its earnings for just three purposes. First, earnings help us build greater financial strength, since a portion of them are invested in our surplus and reserve accounts, the funds that back our ability to pay future claims to policyholders. And because we are a mutual company and not subject to Wall Street's performance demands, we can retain a greater amount of capital for a rainy day. Between 2002 and 2006, more than $5 billion were added to New York Life's surplus. The second way we use earnings is the creation of immediate customer value through dividends paid to our policyholders. This year, we'll pay more than $1.5 billion in dividends to our participating policyholders. Last but not least, our earnings are used to fund growth opportunities such as new business ventures. Through these investments, we create even greater and more diversified sources of future earnings. In all three instances, our policyholders benefit. That's why we describe mutuality as a closed-loop system. In other words, the earnings we generate each year flow back to our policyholders, giving them greater protection and more value for their insurance dollars. At publicly owned life insurers, this loop between the company and its policyholders has a permanent leak because a portion of the earnings is continually siphoned off to investors. The benefits of our mutuality were brought into sharp focus early in 2007 when we became concerned about where the bond market was heading and that we weren't getting appropriately compensated for taking investment risk. Before the subprime crisis hit, we implemented a temporary shift in our investment strategy, moving from corporate debt and real estate loans to safe U.S. Treasury bonds. We were prepared to give up short-term earnings to protect long-term financial strength. Because we are a mutual, that was an easy decision for us to make, and it was the right decision for the protection of our policyholders. It all adds up to this. Because we are a mutual, the interests of the company and the policyholders are fully aligned. I believe this is one more reason why New York Life is a leading seller of life insurance in the United States. And it's one more reason why, for millions of American families, New York Life will always be the company you keep.